Hello, my name is Michael Caplice, and I'm Cushman & Wakefield's Senior Managing Director of Office Leasing for the GTA. Today, it's my pleasure to introduce you to Scott Chandler, my friend and colleague who heads up our valuation and advisory business. Scott has joined us today to shed some light on the booming commercial property investment market in the GTA. Welcome, Scott.
Morning, Michael.
So 2012 is a record year for investment activity in the GTA, both in terms of total dollar volume and total number of transactions. Where are we in these early innings of 2013?
Well, it is early innings, and we're certainly seeing a lot of activity even this mid-January timeframe. For the most part, it looks like a continuation of 2012. I'm not sure if we'll get as strong of investment volume as we did last year, but certainly the environment with low interest rates, strong fundamentals continues, and I would think that would continue to drive strong investment transaction volume. So
if volume declines, where does the Canadian institutional investor look for returns in real estate?
Well, no doubt they've already started to look abroad, and that's a continuing trend of the last few years. In fact, Canadian pension funds were the largest global investors in the world in 2012, and they certainly remain active even early in 2013. And what I find very interesting is Canadian pension funds in Canada domestically are increasingly developers. They're looking for higher yields through development as opposed to trophy assets, which ironically the REITs are starting to win those bids in many cases.
So the pension funds are moving farther out the risk curve?
Well, I think in this current environment, I think that's accurate. I think they're doing it through development and with patient capital, and they can be in a position where some other large investors may not have the ability to have as patient a capital that a pension fund can have, and they're able to increase their yields correspondingly.
So let's talk about the REITs. As you know, Primaris has come into play in recent weeks, and while that story hasn't fully played out, I'm interested to get your perspectives on where you see the REIT market going this year. Is there going to be more consolidation, further privatizations, new formations?
There's definitely going to be new formations. We know there's a couple of REITs that are pending already, and that will come to light in 2013. I'm not sure about consolidations, but you can see why consolidation's happening. REITs are an incredible investment vehicle in Canada right now. They returned more than twice as much as the TSX Composite in 2012, total return. They returned 4 times the bond yield total return in 2012. So incredible asset classes, as proven performer, and you can see why the strength of that performance is generating a lot of consolidation activity and privatization interest.
So you touched on the bond market. Let's talk a little about the debt markets in the context of this vibrant overall environment. And I'm not going to ask you to make an interest rate prediction on camera. However, I'm interested to know if you think that institutional lenders are being paid adequately for the risk they're taking.
Loaded question, thank you. I think Canadian institutional lenders are very astute. They've certainly navigated very turbulent waters over the last few years and have proven they're very good at what they do. The other thing to consider is their cost of capital is extremely low right now. With 10-year bond rates at 1.8%, spreads of 200 and 300 basis points over that have historically been the norm. In fact, are much wider than the risk spreads that they achieved at the height of the market were a fraction of that. So, plus on top of that, in some cases, their insurance in the case of multi-res. So I think the Canadian lenders are very astute, and for sure the corresponding risk to the rate return that they're achieving seems in line.
So let's talk about the urban-suburban divide in the context of the cap markets. What are you seeing there?
Well, it has been a divide. I think that's the right word. We've seen 400 to 500 basis point difference in vacancy rates between core and suburb office, for example, and the industrial environment that's been a little slower to come out of the recession is certainly a reflection of suburban economic activity. I think undoubtedly that reflects a slower economic recovery in the US than in Canada, which has been manifested more in urban recovery in Canada than suburban. And I think that bodes well for 2013. We're going to see, I think, is a more consistent economic recovery in the US, which will help branch plan expansion, the covenant of some of these tenants. And that should help the investment market as vacancy rates in the suburbs decline and the strength of these tenants improve. and demand for new space as well. So I think it should help the investment market divide narrow between those two asset classes.
Thanks, Scott, for sharing your insights today.
Thank you, Mike.
And thank you for tuning in to watch Cushman & Wakefield's face-to-face interview.